Was a ship that put to sea. The name of the ship was a belly of tea. Fired up down below, my bully boys blow. Sea not been 2 weeks from shore, and down on her, right wing aboard, the captain called.
Hi, good evening, everyone, and welcome to Traders Talk. All right, this a second. Okay, all right, great. Today we are going to cover another load of topics, and of course, our guest, Dr. Binky, is actually going to give a trade digest on Amazon, and we'll go through after the market updates. Yeah, and for those who have actually just joined us, this is Meng Hon, and we are actually doing a traders talk. And basically, this show is actually on trading of options, trading of options in the US markets in particular. And of course, options is also available in other various markets worldwide, including Hong Kong, India, and other parts of the world. Yeah, but the bulk of the trades which we do personally on our side, and also the examples which we show here are actually on the US market. So for those people who are actually trading the US market, so this is the show for you. For those people who actually want to learn and to actually grow and improve their trading skills, this is also the show for you to actually see. Yeah. All right. So before we actually start, if you can actually give me a thumbs up so that I know that the sound check is okay, and also if you can like and share the show so that more people can join us, that will be even better. Yeah. So of course, the more input we get from you guys, the more things that we can actually share together. Because this is actually a whole learning process, and great, thank you. And this is a whole learning process, and we are actually going to grow together. Yeah. So the other thing is, of course, we also issue a newsletter. And the newsletter is actually also available for free. Yeah, we have actually given it out for free to everybody. You can actually subscribe to it, and this newsletter will be sent to you every week. Will be actually sent to you every week on a Monday. Which basically we will also cover within this newsletter. Within this newsletter, everything which we teach. And also the market updates is also included in the newsletter. Yep. So for those who have not subscribed, just head to that link to subscribe for the newsletter, and it will be sent to you directly through email. Yeah. And of course, all the past shows which we had for the past year is also contained on our Facebook page. On our Facebook page, which you are actually accessing right here, you can actually go to the videos, and you can actually access more than 50 or 60 shows which we had for more than a year right now, to actually learn about options, capital management, risk management, and also trading, of course. Yeah. So that is also available. Everything for free. In fact, when I started to actually trade options, we had to actually pay thousands of dollars to get proper training to be taught how to actually trade. And of course, right now, when we are actually doing this for quite many years right now, then of course we are also giving this back out to community by doing this kind of training for those people who actually want to learn or even explore how to actually trade. So you can actually follow us on this show. Yeah. Okay. So let's go to the market updates. Let's stop this and share the screen. Market updates. Share. Okay, where is my market update? Let me just double check this again. Okay, all right. Okay, you see the screen, is the screen on? Let me just, no, I haven't shared it actually. Yep, the screen is on. Put me below here. Okay, let's put me below here. Okay, and let me go back to this. Okay, so this is S&P 500, and right now we have actually gone through 2 weeks of a bullish cycle, 2 weeks of a bullish cycle, and of course, last week we had the last Tuesday itself, we had the Fed meeting, right? The Fed interest rate meeting, right? Which basically hiked 75 basis points, which did the hike on Tuesday, and then what happened after Tuesday? Of course, after Tuesday, the market has actually came down a bit. Tuesday was 26, right? So this was actually here, yeah. So on Tuesday itself, this is Tuesday 25th. So the announcement came on 27 itself. 27 is here. Okay, 27 is here, yeah. So what we said, if you follow us last week, right? Okay, on the fan. If you follow us last week, what we did mention on last week's Traders Talk, right, and also on the newsletter itself, which was issued last week Monday, before the Fed rate hike. What we said was that the rally is actually going to continue. The rally, which actually started right here, is actually going to continue right until Tuesday. The rally is actually going to pause a bit, before the rate hike. The rally is actually going to pause a bit before the rate hike. So for those people who have actually made profits on this run, exit on Tuesday itself. Yeah, exit on Tuesday itself, because the market is actually going to risk on before the meeting on Wednesday itself. Before the meeting on Wednesday itself, and of course, in fact, what happened was that the market actually came down on the last 3 days before the meeting, right? On Monday and Tuesday, it actually came down, and we exited all our bullish position. We exited all our bullish position before that, yeah. But of course, post hike again, what happened was the rally continued. The rally continued to go up, because we also mentioned that to say that the expectation for the Fed is basically 75 basis points, and if they actually set it at 75 per market expectation, the market is actually expected to move even higher, yeah. So that actually did happen, and of course, right now we are actually topish here already, and looks like today itself, even yesterday itself, the actually S&P actually tried to break higher, right? To actually try to break higher, but after 2 or 3 hours of trading, it actually came down from the high of the day. You can actually see this candle actually coming down from the high of the day, yeah. And of course, today the futures itself I did saw that it is also red. Red, yeah, it is also red. Let me double check again. Yeah, futures is actually red. S&P is actually down. S&P mini futures is actually down 25 points, and the Nasdaq futures is actually down by 100, close to 100 points. Yeah, so this is also healthy. Yeah, and also expected. And we did also mention that in our newsletter. Yeah, if you actually look at if you have read our newsletter, you would probably also saw the same. Yeah, you probably also saw the same. And if you look at the newsletter here, yeah, where are we here? Okay, what did we say? Yeah, the newsletter we did say that it's actually going to retrace a bit, but going forward, I mean, for the next maybe week or months, my feeling is that this is my personal view, that the market is actually continue to go continue to go bullish. Yeah, continue to go bullish, because the next rate hike is actually going to be on 20th 21st of September, which is basically 2 months away. 2 months away, and of course that will give room for the market to actually breathe back up a bit, provided there is actually no major issues happening in Taiwan. In Taiwan, yeah, because Pelosi is actually going to visit Taiwan, if not mistaken, this week or sometime around. And of course, this is actually expected to strain a bit of the China, US, and Taiwan things going on, right? So I mean, I don't expect a war to actually break out during this trip, but basically, statements and all can actually come out from the US, which may make the market start to become jittery, and as a result, there may be bigger retracements during that time. Yeah, so retracement will come within this week, because on Friday itself, there is also the job reports coming out. The job reports coming out, and of course, if the report is negative, again, that gives the market maker opportunity to actually pull the market down, and shock and make us or investors suffer. Investors suffer. Yeah, and of course, apart from that, the other things on the Russia Ukraine, I would say that the Europe is not is not doing very well. It's not doing very well. You can also see that the Euro US has actually gone almost to parity. Yeah, to parity, and the situation in the biggest economy in the Europe, which is Germany, is also in dire straits right now. Yep, they are not growing, and in fact, a lot of people are also put off job, and because of the energy crisis, a lot of corporations or companies there are also suffering cost-wise. Yeah, so a lot of things are happening there, which is actually not so good for the country, and as a result of that, they would probably ease out a bit to get back food, to get back energy, to actually ease their situation there. Yeah, and of course, on China's side, the things I mean, have not really moved that much since months. Yeah, lockdown is still there. The government is also not putting on a lot of so-called incentives and whatnot to spur and grow the market. They would probably move sideways or continue in their current situation, maybe for some time, some more time. Yeah, and on the other front, you can also see that what is that? The shares in the what is that? The shares in the China, no, the China shares in the US markets. The China shares in the US market is also tanking, right? It's also tanking again. The same talks on delisting. the listing of the Chinese ADRs from the US, and recently Baba has also been named as part of it. Is actually put on that list, and putting more pressure towards um, the regulations to open up their books for audit. Yeah, so that's why you see here the gap coming down for Baba, and of course yesterday itself we see some improvements on that side. Yeah, but I don't know. I mean, personally, I am still risk on for the Chinese stocks, and of course, if Baba continue to actually come down to a lower level, around say 80 81, then probably some short-term trades can would be possible. But around here, I mean, I am still how to say, not so keen to enter into this because of the bigger risk on Baba. But of course, if you actually track this US sorry, this delisting thing on the Chinese stock, right? It actually comes in cycle. I think the last cycle it came, if not mistaken, was somewhere in February, if not mistaken, where all the US all the China stocks on the US actually came plummeting down, and after about 2 weeks, 1 or 2 weeks, then it moderated, and then after that they started to rally back up again, and then after about 2 or 3 months it comes again. It makes me feel like as if this kind of place, right, is actually really for people to actually make money. For people to actually make money every 2 or 3 months, they they start to actually put this news out. They start to put companies on the list. Yeah, on the list. I mean, if really at the end of the day you want to put them on, right, by one, they know that there are 100 or 200 or 300 Chinese companies in there, right, and if they are not fulfilling the criteria, right, you just put all the 200 300 in one time. I mean, it cannot be this month you put this company in, next two or five companies in, then after that you put another five after 3 months. I mean, it's kind of absurd. I mean, if personally, if you ask me, yeah. So again, on that part, this is it. Of course, if you actually want to look at China stocks during this time, JD might be a cheaper stock to actually go in. But of course, yesterday itself, you can see that they have already run back up. I think yesterday itself, JD was actually down about two over dollars, and it closed back higher. Yeah, but of course, JD, you can actually do a play, and in fact, we do have a position on JD, which is actually an iron condor, which we actually put on somewhere yes, we probably put on the iron condor somewhere around here, if not mistaken, somewhere around here, I think we put on an iron condor trade on JD. And basically what an iron condor is that we are actually trading a range. If not taken, the range was actually 47.50 and uh, all the way up till 90, I think. All the way up till 90. Yeah. So we actually traded an iron condor with the short puts, short put spreads on this leg at 47.50, if not mistaken, and the short call spread, the short call is actually sitting at 90. So we got quite a big room to play with, even though I think we did it here. I think we did it somewhere here. Yeah. Otherwise, this is actually not central. I think we did it somewhere here, somewhere at this level instead of here. Yeah. More or less to the middle. And of course, even if JD has actually came down by quite a lot, right, from this level, the trade is actually still quite profitable. Expiry is actually on 19th of August, which is basically about close to 3 weeks, close to 3 weeks, close to 3 weeks. In 50% profit right now for this Iron Condor. Yep. So we have also covered Iron Condor strategy in our newsletter and also in the Traders Talk, I think for last month, if not mistaken. Yep. So if you want to actually study and learn that, go back to the recording. Yep. So coming back to SPX, yeah. So where are we now? We are actually at this level. So we expect the retracement to actually come back down more to a level of these 4,000, 3,009, 4,000 would be the healthy retracement level expected. Yeah, and of course, hopefully it do not come back below this 50 moving average. Yeah, to continue to be bullish short term. Yeah, it has to actually be still above 50. And short term wise, the S&P is already short term bullish because if you look at the 20 moving average, right? If you do the 20 moving average here, let's change this. So if you do the 20 moving average, as I closed yesterday, S&P has actually touched the 50 lah. But of course today if the retracement comes, right, it will probably come back again. If it actually crosses the 50, then it is actually going to be a short-term bullish momentum for the S&P 500. Then, of course, for the Nasdaq, right? Nasdaq is already again short-term bullish because they have the 20 has already crossed the 50 as of even last week. Even as of last week, it has already crossed that. And from the lows here, let's put this back. From the lows here, that means from the lows in June, right? From the lows in June, actually Nasdaq has actually gone up by about 17%, which is quite healthy. I mean, 17%, which is basically almost about 50% of the decline, right? The decline from all-time high here, all the way back here. I think it was about 34%, and currently it has actually retraced by half the position. Okay, let me just get it. Okay, so that's Nasdaq, and of course, again, like I said, retracements is going to be imminent. Imminent, yeah, imminent. Stochastic is right now above 80 is actually overbought. It's actually overbought, and there's no problem to do a slight retracement. Yeah. So of course that comes to what we actually wanted to share with you guys today, right? That comes what strategy we actually wanted to share with you guys with this kind of the market moving around, where it goes up, it comes down, it goes up, it comes down. Then of course within the option strategies, we do have some strategies where we can actually adopt and actually apply to be still profit, to still make profit in the market despite this kind of market volatility. Let me just share the screen. Okay, all right. So last week we actually covered the covered call. Yeah, last week we actually covered. We did explain on covered call, and of course, covered call is also suitable during markets like this, where basically they have a spurt of rally going into the stock rallying, going into overbought position, making a retracement coming down. yeah, and then taking a breather and then going up on the next leg up. Yeah. So of course, last week we did say that if you have 100 shares in any counters, right, then you can actually take this opportunity to generate some income during the retracements, generate some income during the retracements, because you're not going to sell your shares anyway, because this might be long-term holdings or whatnot. Then of course during those retracement you can actually sell a call at out of money call to actually generate additional income. Yeah. And that was actually that was actually the what is that? Let me just put this. That was actually a covered call. Yeah. So this is let me just put this here. This. Okay, so you can see the slides, right? Let me just check the screen. Okay, so that was actually a covered call, which we actually taught you guys last week. Because I'm looking for the pen. Okay, but why is the pen not coming on? Something. I need to exit Postman. No. Okay. Why I cannot? Okay, the pen is out. Okay, all right. So here, let me go back. So covered call. Sorry about that. So and my pen is gone. Okay now. Okay, doesn't matter. So last week we actually covered covered call, buying 100 shares, selling short-term out of money calls. Yeah. So today I'm just going to compare you guys with between a covered call and also a diagonal. Yep, diagonal we also covered it. I think in our traders talk in April or May, if not mistaken, April or May, if not mistaken, you can go there to actually look at the strategy itself. Yeah. So today we are not really going deep in back to the strategy. We are following through from what we actually taught you guys during the April traders talk and May newsletter, if not mistaken. Yeah. So we'll post on the link. We will post on the link later on where you can actually get those details. And we are just going to cover a trade where we actually did on Amazon, a diagonal trade on Amazon. Yeah. So what this diagonal trade is actually a version of a covered call where you do not actually need to own the 100 shares. Yeah. Because in order to buy Amazon 100 shares at $122, right? Which was last month, right? Basically, you need $12,200 of capital. Even if you use margin, then you will need about close to $4,000, yeah, US dollar. So instead of putting up $12,000 to actually utilize this strategy, we do a diagonal, which is a version, a poor man version lah, version that suits me lah, because I'm poor, right? Because to do a diagonal, we don't need to buy the 100 shares. We try to actually structure out an options which mirrors or acts as if it is 100 shares. Yeah, act as if it is 100 shares. And how we actually try to mirror holding 100 shares with options, right, is actually buying deep in the money calls. And of course, what is deep in the money? Deep in the money means that you will buy a call at a strike below the current traded price. For example, in this trade, Amazon at that point in time were trading at $122. And when we structure out this trade, we actually bought a call at $103. Yeah. Yeah, we bought a call at $103. Okay, we bought a call at $103, and basically this call is has a delta of 80 lah. And of course, if you guys are familiar with delta measures basically $1 movement in the share price, how much movement in the options, and 80 delta would mean that for every dollar movement in the share price, the the option would actually move by 80 cents. Yeah, so it is actually similar lah, I mean, to the stocks, because for stocks, if you own 100, if you own one share, if you own the share, for every dollar movement, in 100 shares, right, you actually make $1, right? $1. No, sorry, sorry, for every dollar movement, your shares will actually increase by $1 lah, 1 to 1, right? Whereas for options, if you're buying a dip in the money, this 80 delta would actually move up by 80 cents for every dollar. So it is actually 80% of the movement. So we structure it that way to mirror 100 shares. Yeah. And of course, the other leg is actually selling out of money calls. And what is this out of money calls? Out of money would mean that we actually choose a strike price which is actually above $122. Above $122 is out of money. Yeah, out of money. That's what we call out of money. Yeah. And when we sell these out of money calls, we actually get to collect premium. For example, in our trade, which we were going to show you right now, we actually sold a weekly premium. I think that time was probably about 8 or 9 days, 8 or 9 days expiry, and we actually collected 120. So the full trade cost is actually 22.58. Yeah, sorry, the full trade the call at 80 delta 103 strike, I think we did a September expiry. So to structure this out, you need to do at least a 3 months expiry for the long call, and that long call at 103 strike, we actually bought it at 23.70. Yeah, 23.70, and we collected a premium to sell out of money call, which I think we did that at $129 at this is 103, and the out of money call, we sold it at 129. Yeah, so we did 103 for this September expiry, and this options, I think there is a weekly expiry at 129, collected 120, paid 23.70, collected 120, so the net would be about 22.58. Yeah, so the net cost to enter this trade is 22.58. That means $2,250. Yeah, as compared to paying $12,000 to actually buy 100 shares. Yeah, and entering into the same short calls to get this same premium. Yeah, and of course, we had this capital, and of course, the premium which we sold was 120, say 120 a week. And if you just continue to do this, right, what we basically try to achieve is to collect 480 a month, with 2,370 of capital. And of course, that would actually equate to 20% return, 20% return for the month. Yeah, that is actually the best scenario, the best target which we actually do. Yeah, and of course, if you do this with 12,000 capital, you will actually get 4% return. Even if you use margin, then your return is the same return, is actually about 13%. So it's actually cheaper capital wise to actually structure out a trade with similarities of features using a diagonal. Yeah, a diagonal. So this was the thing. The net cost which we actually entered is 22.58 at when we did the trade was this price. And for this transaction, the trade, that means I think what we did was in total we was in the trade for 52 days. In total, the premium which we collected was about 557, which is a $557. Yeah, and we exited at this price when Amazon price actually shot up to 135. So the total gain for this was actually about 578, which is actually quite good, 20% return in 52 days. So that's why when we post this show up, right, what we actually tried to show is that with $2,000 of capital, right? So with $2,000 of capital, you can actually generate around say for this trade, let's put it 600 lah. Yep, let's put it 600. You can actually sorry, not $600. $600 in 2 months time. Yeah, in 2 months time, for this kind of structure, and then it's actually quite a good return because you're actually getting a cash flow of about $300 a month, based on a capital of slightly above $2,000 lah. Yeah, so I mean, what does that equate to, right? It's actually a so-called yield, right? Let's say 300 divided by let's put 2,000 for simplicity. So it's actually a yield of about 15%. Yeah, 15% a month, 15% a month, right? A month. So even if you are that bad even if you are that bad, you don't generate 15% a month, you generate half of this, you will also you can also target to actually achieve. You can also target to achieve about 7% return a month with 2,000 of capital. Whereas a lot of people actually put a lot of capital, say buying a property. So buying a property, when they actually buy a property, they need to actually put up much more capital, right? Say, for example, to generate a cash flow of 300 times by 4 is about 1,002, right? 1,002. Okay, to generate a Malaysian ringgit 1,002 of rental, right? Basically, you need roughly within the market, right? You actually need to put in or buy own a property which is actually worth. Where's my pen again? To generate say $300, say this is about say 1,200 ringgit, Malaysian ringgit RM. Yeah, you need to actually buy a house at least valued at say 400K RM. Yeah, 400K to generate a rental of this 1,002 a month. You actually need to put 400K. I mean, let's assume you put in cash lah. You are rich, you put in 400,000 cash to generate 1,002 cash flow. And basically, what kind of yield you're actually getting? 1,002 times by 12 divided by 400K, right? You're getting a yield of 3.6%. Yeah, 3.6%, which is normal lah. I mean, for a property, 3.6% yield is actually quite reasonable. Quite reasonable. If you can get 3.6 in today's market, is actually already very good. Yeah. In fact, people don't even get I think one or even negative. If you count on to say you borrow money to actually do this, right, you will probably end up with either zero or even negative. Yeah. But if you guys work on putting on a little bit of capital, trying to actually learn investment structures like options, using options, right? Basically, that can actually enhance your so-called investment return on your capital, whichever capital you have. Much more, yeah, much more. But of course, I'm not saying that there is no risk involved in trading options. There's always risk, but of course, you need to actually learn how to manage this kind of risk and also how to actually structure out option strategies within the correct timing, within the correct stocks to choose and all. Yeah, you need to actually learn how to do that. Yeah, coming back to our trade, right? This was actually the trade which we did. I mean, this is actually a live trade. I mean, it's not that I'm making up the numbers. So this is actually a live trade which we did. We entered the trade on 6th of. We entered the trade on this date. We entered the trade on this date. Why is the pen doing? We entered the trade on this date, 8th of June. 8th of June. we paid net of 2258. We paid net of 2258, and the red ones are actually the credits which we received lah. Basically, these are the out of money calls which we sold during the 52 days. Yeah. So this was actually one which we sold on 10th of June. We collected 120, and then 23rd of June we sold another one at 150, yeah. And then on 30th we bought back the one which we sold at 150, and then we did not do any one. We sold another one on 2nd of July. We collected another $2, and then after that we rolled the trade. We collected another 75 cents, and then after that we closed the whole trade. We paid 138. We paid 138 to buy back this position. This position here we bought back, and then again we started to sell again at 155, and at the end we closed it at 22.79. Of course, if you look at this, right, different timing, sometimes we get different kind of premium. Sometimes we buy back, sometimes we roll with a smaller credit, sometimes here again we bought back at a loss. It all depends on the price action of the stock during that time, or during the time you are actually in the trade. And what do I mean by that is this is it. Okay, so if you're actually in a trade, right, at different point in time, your option value would actually change accordingly based on the stock's price action. And in order for you to become good at this, you need to actually know if the price comes down, what will actually happen to your out of money call, and what will actually happen to your long call, and the effects to the option pricing. So that you really need to actually understand. And of course, you need to go through the basic options training or strategies to actually understand that. And then with that, then you actually put it into use to actually execute trades like this diagonal. Yeah. So to explain a bit, take another 5 minutes to actually explain what we did here, and basically how the price action affect what actions we did. Yeah. So as I said, we actually entered the trade here. We actually entered the trade during this red bar here. Here we actually entered the trade here. And why we actually entered the trade here is because Amazon did their stock split on this date here, did their stock split on this date here. And of course, after the stock split, Amazon had actually rallied up, which is this green candle here. It has actually rallied up. And at that point in time, I would say, okay, it went up a lot, it retraced. I would actually expect Amazon to continue to retrace back a bit. So at that time, what we did was we entered into a diagonal. Okay, and remember, we actually wanted to buy a deep in the money call, yeah, which was actually at strike 103, which is somewhere around here. 103 is here, yeah. Deep in the money call, in the money call, which is at this strike price here. The current price is running at 122 here, and then we sold out of money call, which is at this level here, yeah, which is at this level, which is what, at 129, yeah. So what we actually want the price to move is, do we want the price on expiry of the short call, which we did here, which was slightly about a week, a week time, right? We wanted the Amazon price to actually close below this price, 129. And of course, once it closed below, what will happen is that this call, which we sold for, I think this one we did at 112. Yeah, the first one we did at 112. And this one would actually expire out of money. This 129, 9 days expiry, will expire out of money, and that premium, which is 112 US dollar, 112 US dollar, we keep it for free. Yeah. But the other side of it, on the long call, which we did at 103, right, would have a negative effect. Yeah, will have a negative effect, because remember, this is actually mirror stock. We try to mirror stock, and of course, if the stock price come down from 122, all the way, it actually came down all the way here, right? We actually came down all the way here, right? You would actually lose money, and it came down about $20 during this period. It came down about $20 during this period, and say at the date 80 delta $20, probably you lose thousand over thousand plus dollar on this long call. You probably lose thousand over dollars, but you this $100 over dollars you keep. Yeah, but of course, this huge movement was also unexpected because the market actually had um, a big retracement during that time. And of course, Amazon also followed suit. It actually plunged down, but because Amazon, for me, I believe in Amazon. I think it is actually fundamentally strong, and as a result, at 103 level, I think that it can actually form a good support. Even if it falls, it would probably not go far away from that, and it would probably go back up. That was my hypothesis, although it has actually lost value of about $1,000 over dollars during that time, right? So I still kept on the position, yeah, because you can see at these levels, right? When it actually went down to these levels, it bounced up, went down to this level, it bounced up, and now it coming back to this level. I would actually expect it to bounce up. So at that time, I did not close the position. I continued to roll the thing, and I collected another 120 for that. I think I rolled it again at 129. Yeah, I rolled it again at 129. 129 is quite far. Here, I rolled it again at the same strike to collect more premium, which I collected $1.20 premium on top of the 112 which I collected earlier. Yeah, and of course, after that, the price has actually rallied up, and here again, after on the expiry, yeah, the third round, I did at 129 again. 129 was up here, right? Yeah. Again, the second time, the out of money call continued to be out of money, so I keep that premium, and I continue to roll it for more premiums. I collected another 150 premium on the third rolling, on the third time. For the third time, I collected another out of money call of 150, and that time I actually reduced the strike price. Instead of continue to roll it at 129, I actually only did it at 115. Yeah, 115 here, 115 here. Yeah, 115 here. And of course, during this time, I think till here, it actually shot up above, right? So of course, when it was here, the long call would increase in value, but the in between, the short call would be in the money, because it went above 115, right? But of course, before the closing, it again came back down below 115, and as a result of that, I closed the position. I paid 5 cents to buy back the options. Yeah, I paid 5 cents to buy back the options, and I did not do any more. I did not sell any more calls during that time, because I think that Amazon would be oversold, and I wanted just to get the increased value in the long call without having a short call to actually cap the profits. So I let it go up a bit. And of course it went up lah. It went up, and I think during this time here, I sold another one at $2. Yeah, at 110 strike. Yeah, at 110 strike, slightly lower. Yeah, I collected more premium. 110 strike here. So of course, then on expiry, it became in the money, right? So the fourth call which I sold was in the money. Then what I did was I rolled it again at the same strike, because it's already in the money, right? I cannot roll it higher, because if I roll it higher, I have to actually pay to roll. Yeah, pay to roll. And in options, if you are rolling, we try to actually collect money to roll. Roll means to extend the option duration for another week, another time, a longer period. So we are actually extending the duration. So that time we did another rolling at the same strike because it was in the money, and we wrote it for 75 cents. We wrote it for 75 cents, collected another 75 cents. And after that, what happened was the Amazon price came down, came down, came down. And here again, we we closed the we closed the position here. We closed the position here, but at that time, we closed the position here and we paid 138. We paid 138 to close the position. Why I closed the position is because that means before expiry, I actually closed the position. Why I closed the position is because I felt that Amazon is actually going to rally, and if I don't buy back this call, right, this call will start to make this short call will actually start to lose money. Will actually start to lose money. So I bought back that call at 138, and I let the profit come back from the long call. And of course, the price did went up. And at this point in time, I felt okay. It's time to again sell the call again. So I sold another call at strike price 125 and collected 155 here. Yeah. So of course, I think I did 2 weeks, if not mistaken. One or two should be 2 weeks. I did a 2 weeks. I collected 155 here. And lastly, what happened was that after earnings, right, I kept this trade along throughout earnings, yeah. Because for me, I know how to manage the risk, so I kept this through earnings. And of course, once it did earnings, Amazon popped up. Amazon popped up to about $130 over. And of course, when that happened, you will actually lose money on the short call strike, but you will make a lot of money on the long call. You will make a lot of money on the long call, and of course, that loss and will neutralize by itself. Will neutralize by itself because you are actually capping your profit at 125, even though it goes to 135. So you have sold a short call at 125. Basically, you are capping your profits. So because it has actually already went up so far towards my short call, right? So I just closed the position and collected back 22.79, which was close to the price which I bought it for. Yeah, I bought it at 22.58. I closed it at 22.79, which is even higher, few cents higher than the price I entered into the position. But the thing is, don't forget that along all these lines here, along all the time here, I started to collect premium, and as a result of that, I collected total of $500 over of premium along this 52 days. 52 days, yeah, 52 days, and that would actually form your income or on your capital of $2,000, which is your profit. I think all in this trade basically made about 22%, 20 over percent of profits within what is that? Less than 2 months. Within 2 months. Yeah. Yeah. So that was the trade which we did yeah. So that was actually the Trade Digest on Amazon. Yeah. So if you actually really understand, if you really actually understand the thing, right? What we are actually doing here is that we are actually playing around based on the price action of Amazon, right? I mean, sorry, Cindy, I just saw your note. You didn't really see the chart, is it? But anyway, the things are also very small. I can probably put it up again, just for you to see again. But basically, what we did here is let me see, where did that go? What we did here was basically play around with the price action of the stock, right? The stock, and try to actually sell premium, right? Try to actually sell premium sell premium along the way, right? Sell premium along the way to generate income, to sell premium along the way to generate income. I can actually post this chart later on the sharing, right? I can post this. You can actually also have a look and understand more on this. So what we did is, whenever the price movements, right, we're actually trying to use options, right, to actually try to generate returns for us, yeah, because um and of course these are all structures. We cannot just sell a naked call. We cannot just sell a naked call just to get the income, because selling a naked call actually involves a lot of risk. So that's why we have a long call sitting there to actually manage the short call risk, in case, like for example, when they did the earnings, the price shot up to 135, and you are actually having a short call at 125, right? So basically you need to actually cover that $10 difference if you only have a short position, if you only have a short call position. But of course, with the long call sitting there, the long call will also increase in value close to $10, or around, depending on the delta lah. I mean, if it is 90 delta, then it will be probably $9 to actually cover the position, to cover the so-called losses from the short call. So these are the things which we actually need to really understand, the behavior of the long and short, and also the price action of the stock, and all this price action of the stock will also influence whether you close the trade, whether you extend the trade, whether you roll the trade, will also influence that decisions. And of course, all this would come through from practice and understanding about option movements, and also the uh, the value of the changes in value of options based on the changes in the price. Yeah, and of course, the technical analysis stuff also add value to you to actually estimate or try to make good analytical review on how likely is the price to continue going up, or it can actually come down based on certain what is that certain things, the what is that the things like using stochastics, or using Bollinger Band, and using support or resistance level to actually try to determine what may be possible to the price action of the stock. Yeah. So if you have any questions on what I shared, I mean, it may be a bit deep lah. Yeah, it may be a bit deep. But at the end of the day, you need to practice. You need to practice. Watch the video 10 times. Watch the video 10 times. And of course, if you don't understand, if you have problems, come back to us, send us an email, or even post on our Facebook. Then at least you can get to solve your questions, and also the other people in the community can also read up the answer, and also they can also benefit. Yeah. So if you have any questions, please post. If not, I think I had a very deep session today with you guys. And I hope you can actually make good use of what I've actually shared today. Yep. So if you like this, give me a thumbs up if you have actually benefited from our show. Yep. Please help us share this to more people, so that more people can actually benefit also. Yep. So they can also go through the recording. It is totally fine, and of course, if they go on the live show, it's even better, so that we can actually answer or address any of your questions directly if you have. Yeah. So until next week, this week, please be a bit careful on your long trades. If you have any, take profit. As I said, if you have any profits, keep it first. Yeah. and be light on your trade this week. If you are long, of course, if you are short, it's fine. And if you want to how to say, if you want to manage some of your risk and you want to actually do some hedging, you can also go to SDS. You can also do the ultra short SDS trade. You can actually do that if you actually want to hedge using options. Yeah. Okay. So until next week. So I'll catch up with you again on Trader Stock. Okay. Thank you. Bye bye.